A mixed story in Europe. London is lagging, certainly today. Energy stocks are getting crunched by crude, which is down sharply. The engineering story, much more positive. Germany rises. The Siemens story doing the heavy lifting there. That company painting a much more positive picture. We'll deal with these kind of different narratives and how they fit together as we work our way through the next hour. Plus, we need to talk about China. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Single stock swings continue to be absolutely massive in this market. Getting whipped around hugely on just kind of little changes, little shifts in the market narrative, and you're getting big outsized reactions. Stock 600, yeah, it's down by 0.6% today. But look at HelloFresh and Burberry. You could look at these numbers and go, oh, that's the year move, isn't it? No, this is the one-day move. Look at what's happening in the States right now with Macy's and Walmart, etc. Similar kind of narrative. HelloFresh. The food kit business, largely based out of Asia, domiciled in Germany, reiterated guidance 3 weeks ago. Today changed it. Look at how the market is punishing that negative guidance shift. Down by 21% today. That's not an annual number. That's a daily number. Burberry. I thought we knew that the luxury sector was having a tough time of things. Burberry comes out today and doesn't deliver. And it gets absolutely smashed. We're down by 10%. The market, I thought, understood that we are seeing a slowdown in the sector. I thought it understood that maybe Burberry's price point was maybe a little bit too punchy. Today's numbers really, once again, and the guidance in particular, and how the market, the consumer market is treating the new designer they've got over there, didn't work. Burberry down by 9.92% today. So, Alex, you could be confused thinking these are yearly numbers. They're not. The single stock swings are epic.
Yeah, and, take a seat for this one, but I agree completely with you. Just take a look at Cisco, for example, down almost 12%. We haven't seen that kind of drop since in about 18 months. And the question is, the CEO himself said that there wasn't a macro signal in there. There just weren't a lot of new orders because their customers are working through the stuff that they already ordered. And it gets hit almost 12%. Headline level, nothing to see here. You got the S&P just off by about 0.1%. But like Guy had mentioned, individually, just look at Walmart, look at Macy's, how you get beat and punished just so much just by the numbers. All of this leading to some safe haven flow into the Treasury market. The belly get down by about 10 basis points here. We're down by about 8 on the 10-year. Also, home builder sentiment, not that great. Industrial production, not that great. Initial jobless claims tick up a little bit, but all of that sort of in the zeitgeist of that Goldilocks soft-ish landing scenario. The question mark is with crude, down 4%. Sure, stockpiles rose yesterday. Okay, we kind of knew that. It seems like the market's taking that more as a disinflationary impulse rather than a global growth question. However, this is a big downside move that we've seen for crude in just the last week, Guy.
It's amazing, isn't it? And the market's certainly poking OPEC, seeing whether or not it is going to be prepared to make further cuts. We'll wait and watch on that front. The China narrative is never far away, though, isn't it? And it's fascinating to see how the market is positioned in the context of what we saw yesterday with the Biden-Xi meeting. Europe certainly paying attention to that with a great deal of interest. But positioning is fascinating around this narrative. It was interesting listening to Amy Selico talking about the fact that she wasn't talking to US CEOs. He didn't seem to be talking to the market, encouraging the kind of investment, a kind of reversal of this position that we see here. This is the Bank of America Fund Managers Survey, the latest survey. Long big tech. We know that. That's the kind of the positive story. US tech is in a good position. Short China equities. Look at what Alibaba is doing today, Alex, and it's pulling some of its big IPOs that it was going to be planning to spin out. It's just, there was nothing there maybe to change that narrative. Or is the story changing without that narrative shifting within what President Xi is saying?
Right. So it's sort of, on the one hand, you have actual Chinese equities, and that short really illustrating the governance issues, right? And then you have the companies and the clients of China, which is who were all in that room yesterday that Amy was talking about. And some CEOs are starting to see a bit of a recovery there. So Siemens CEO Roland Busch did join Bloomberg TV earlier to talk about how the conglomerate is positioning in China, especially for the back half.
China is still a weak market, several reasons. You know that the private consumption is not picking up. Obviously, as a major exporter, they're also having a drawback by the weak economy. So what we are looking closely into, let's say, the start of the calendar year. So we believe in the second half of the year there will be momentum, eventually after Chinese New Year.
So Siemens sees things starting to improve. It's got very dark, but maybe there's light at the end of the tunnel. Takes us back to our question of the day. Brings us back to those shorts we were just talking about. Is China more investable after the summit we have just seen? To discuss, Christine Aquino from our Markets Today team and Bloomberg's JP Barnett joining us from our MLive team. JP, I'm going to start with you. Did the summit change anything? If you're sitting here in Europe and you're watching this US-China relationship sort of moving slowly, maybe a little bit more positive, how do we read it? Was there something there?
Well, very, very little, I would say. The good news is probably that it didn't make things worse. But the big issues that are still like keeping investors away from China have not been touched even though. And even the small compromises that we have seen out of this meeting, we are hearing had like tough work and hard work to come by with. So I would say like China is still a difficult play in the very short term. Will it remain a growth story over the next 10 years? Sure. But if you want to time the bottom here or play something for 2024, you probably can, but it's still like a lot of risk involved, I would say.
Sure. I guess, Christine, when you take a look at the fund manager survey, like sentiment really stinks. Like positioning is still really short. So there are two different stories. One is if you're a CEO, and then one if you're actually investing in Chinese equities. I mean, was there enough to cover a short there, or is it you just can't do that right now until you get some real fiscal stimulus?
Yeah, absolutely, Alex. I mean, I think it's difficult to kind of shift that positioning really just because it's been so overwhelmingly negative for the rest of the year, right? Or so far this year. And, you know, it's difficult to kind of trade off of anything that you might hear from a summit like this just because it doesn't necessarily translate into concrete policy and we don't necessarily see the impact of it immediately, right? I mean, we could be hearing one thing from Biden and Xi during this summit, but then in the way that kind of the U.S. and China conduct their respective policies afterwards could be a completely different thing. And so for investors, it's really hard to kind of pin anything on this sort of thing. And I think the Siemens CEO actually nailed it on the head. It's not really a geopolitical international relations issue for China and investors. It's really all about that private consumption, that domestic economic story that's really still keeping a lot of investors at bay.
It is, but maybe there's signs of improvement, Christine. Are we bottoming out? And if we do bottom out, are investors going to be willing to go back in? Or are they going to be put off by the narrative that is coming from Beijing? The fact that it seems to be a fairly indiscriminate approach when it comes to dealing with foreign firms. We're seeing pushback against foreign firms. Even if the economy improves, will investors go back in?
Yeah, very big question, Guy, right? How are foreign firms going to be treated moving forward in China? And definitely a question that's hanging over a lot of investors. And I think, you know, there is a point to be made about how the sentiment is so overwhelmingly negative. Like JP was saying, you could probably have some value hunters piling back in. The question, I think, for investors is, you know, if you're a value investor and you're thinking, oh, you know, it can't possibly get much worse in China, if you're piling into that trade, are you able to stay solvent long enough for things to actually turn around? Because this is really going to be a question of timing. We haven't seen that turnaround just yet. It's difficult to see kind of how quickly they can get back on track in terms of economic growth. It might be a position that you'll have to hold for quite some time before you actually see it coming to fruition.
Hey, JP, foreign direct investment really stinks. Have we found a bottom here from that perspective?
Oh, that's very difficult to tell, I would say. But like, I mean, like everybody who invests in China, they know that you take a lot of risk, how companies are being treated, foreign companies are being treated, how foreign investors are being treated. And on top of that, you also have the huge like regulatory domestic risk that you're taking as an investor, because we have seen like lots of stocks getting punished because China is releasing domestic regulation to rule in tech companies, to take care of education. And you also have to deal with that as a foreign investor. And that's something that's kind of a minefield that's very hard to navigate because you have no visibility, you have no like real time frame on what's going on. So it's very difficult for foreign investors to navigate that thing.
JP, what does this mean for European stocks? Europe is much more tied into what happens with China. How big a proxy, how tied together are they? If investment in China improves, if sentiment improves, how does that ripple through back into Europe?
Well, it does definitely ripple through, and we have seen that reopening trade vibrating much more in Europe than we have seen with U.S. stocks, and that's still going to be the case for some time. That said, we are also seeing that trend of deglobalization and like decoupling of supply chains and putting stuff more local and more domestically, as we have seen over the last 2 years, that this can create some issues if the world goes upside down. So I guess we are still on that path that Europe is trying to decouple from China, and China is also like in a transformative state, I would say, where they go from quantity towards quality and becoming more of a competitor for European companies and U.S. companies when it comes to innovation, intellectual property, and so on and so forth. So Europe will also like try to decouple themselves a little bit more here from China to not run into the problem that China is on the way to become a real competitor, and then you become issues here. So for the moment, and I would still say for the next couple of years, there's still a strong link between the two regions, but it's getting smaller and smaller and smaller.
Yeah, that's so interesting because as it gets smaller, you have to wonder what the industrial base, particularly in Germany, does, right? Like you heard from Siemens, like, yeah, it's tough, but maybe it'll get better. Like a luxury retailer like an LVMH has a whole world to sell to, and Siemens, how much of it relies on, say, China. I'm just wondering, Christine, if we're going to look at sector bases for a recovery, where do we look at that now?
Yeah.
Like the luxury play didn't pan out.
No, definitely.
Right? So where do we see?
I mean, I think really what we're kind of in this sort of environment where if you're a company that has a decent cash flow position, you don't have a lot of debt, and so you're not very exposed to a lot of these still changing narratives on interest rates, and you have modest revenues, not like outsized revenues, right? You're not necessarily relying on an overly positive growth story because we're not getting that. If you're kind of hitting that sweet spot, if you're the sort of company that hits that sweet spot, then you're probably best positioned to kind of outperform in this sort of environment. Because, yeah, it's really kind of what comes with a soft landing narrative, of course, is that nothing is really going to be outsized, right? Inflation is not, right? That's kind of moderating. But also at the same time, growth won't be. And so if you're a company, particularly in the big tech sector, I mean, a lot of positive sentiment still in that sector, despite quite a punishing earnings season that we've just had. And there's probably a lot of kind of room to moderate there. But yeah, if it's a particular sector that's kind of geared toward lower debt, decent revenues, decent cash flow, then you're probably going to be okay heading into 2024.
Yeah, I'm like, what is that sector, particularly as exposed to China? All right, guys, thanks a lot. Christina Aquino from our Bloomberg Markets Today team. Bloomberg Markets Today team. There we go. And Bloomberg's JP Barnett. Thanks a lot, guys. All right, coming up, more insight into the question of the day. Is China more investable after the summit? Virginie Messonnieuve is Allianz Global Investors Global Equity CIO. She joins us next. This is Bloomberg.
There are a few different issues that are keeping investors out of China. The big issues have been AI and the technology transfer from the U.S. to China. The ability for the Chinese government to have a very heavy hand on investable Chinese companies. So they run it for the people versus for the benefit of the shareholders. And Taiwan, which is kind of the most obvious one where, we are never going to agree with them on their take on Taiwan.
Scott Crawford, Executive Vice President and Portfolio Manager at Alta, speaking to Alex and I in the last hour. Takes us back to our question of the day. Is China more investable after the summit we've just seen? Joining us now, Virginie Messonnieuve, Allianz Global Investors Global Equity CIO. Virginie, great to see you. How investable is China?
Well, China is very investable. The West has capitulated, I would say, on China. And of course, it is an emerging market economy. Is the meeting that took place yesterday creating a difference? I think it is, in the sense that it's the crystallization of some kind of rapprochement, which has been really in the making for the past 6 months, I would say. And I would think that geopolitics has quite a bit to do with it. So I think, the digital Darwinism war is still there, but geopolitics is definitely underpinning this, in my view.
So can I invest in that? So the cool down, like things are not going to get worse. Is there a play there?
I think it depends on what's your time horizon and what's your allocation, right? What is your allocation range? I look at China as an asset class. It's such a large market. So, we know second largest economy in the world. China is also at a crossroad in terms of new economy, old economy. So, of course, there's a lot of focus on the property market. But if you look at the end of 2022, 18% of GDP was represented by the new economy. So if you take tech, health tech, financial services, etc., and all of this, and of course, green economy as well, right? All of this is very large now. And my guess is that at the end of the year, at the end of 23, it's possible that we're on par with property or even higher.
Virginie, why is therefore the market so short of China? And how big a swing when the market changes will we see?
Well, so as you know, now most foreign investors have capitulated. So the domestic, and I'm talking about the A-share market, is dominated by domestic investors. And domestic investors, as you know, are running a lot of cash. There is a confidence issue in China. But when they return to the market, my belief is that the market will perform very strongly. At that point in time, I think foreigners will look at it again. But you have to be very discerning. You want to buy innovation. You don't want to buy an ETF in China. You really have to look at ESG as much as possible. And I think you raised a very good point earlier on. And really the green calibration, you have to be extremely selective.
So what's the read-through then to, say, the European market, right? So that trade in the beginning of the year was full-on luxury. We know that's not looking great. Just take a look at, say, Burberry, for example. What's the read-through? Is it going to be industrials? Is it like a Siemens, like we heard today?
I think it really depends, right? It's a bottom-up exercise. I think the times of the top-down, you buy luxury or you buy industrials and you just close, those days are over. It all depends on the footprint on the ground, which area you're really in. As you know, even in terms of luxury, you have competition from domestic brands, right? So it's a new China. It's China 2.0. I would say China 3.0. As you know, I think of China being in the third phase of its big development. And it will be beneficial to Europe, but you have to be very selective.
Virginie, can you play it through Europe? How would you play it through Europe? It is going to be beneficial, as you say, but where?
Well, through Europe is one thing, but really I think you want to have a share direct exposure, right? Because then you can really select the companies, particularly in the innovation space. There's a lot of really interesting tech companies, green companies. I think this is it. Otherwise, you go to the second derivative. And as you know, I can't talk about names, now, but you have to go in those sectors. Where do you see the leverage to benefit from that, and where you can add value to what's already on the ground in China, where that vested interest to work together is very strong. That's very key.
Do you think that the energy transition is part of that thesis?
Yes.
Because you could make yes, they're going to be investing money there, particularly when it comes to, say, importing LNG. But is the will there? Is the money really going to come? Is that a way to play this?
Yes, definitely. So as you know, the same way the whole end-to-end supply chain for AI is in Taiwan, the whole end-to-end supply chain for green energy, if you want, is in China. And this is a very strong sector. And of course, we know that pricing can have a big impact in that area. But if you look at electric vehicle, for example, so many electric cars now, and even in terms of energy. So the economy is really powering and, in my view, gaining competitive advantage versus a lot of other countries as this carbon wall, or I call it the warm war, if you want, is coming upon us over the next couple of decades, right?
So interesting. All right, Virginie, thank you very much. Virginie Massegneuve of Allianz Global Investors. Thank you so much. Wonderful insight. Coming up, we'll go to luxury again. Burberry sending warning signs that this year's revenue targets may be out of reach. I mean, I agree with Guy on this one. That feels like a very strong reaction for numbers that we knew were kind of coming. We're going to break that down next. This is Bloomberg.
Inflation came down pretty significantly, and that's both headline and core. But the biggest contributor was really energy, so not a huge surprise, but good news for sure. The labor market data was also pretty positive. Wage growth decelerated a little bit. It's still incredibly high, though, and so I would put all of this in the category of good news. But I think there are still reasons to worry about the persistence of inflation in the UK.
The Bank of England's MPC's Megan Green talking to Francine Lacroix a little bit earlier on, basically just highlighting her view that actually rates are going to have to stay higher for longer, that the journey back down to 2% is going to be difficult for the Bank of England, and essentially that the consumer is going to have to be put under more pressure, that the economy is going to have to be put under more pressure. Wage growth is still relatively strong. The labour market has slowed down, but maybe not enough. And that kind of feeds through into the overall narrative that we're seeing with the consumer at the moment globally. And you can kind of see that reflected, and you've certainly seen that reflected over the last few days with this sector here, the luxury sector, which has been under pressure for a little while. Burberry's the latest one, Alex, to kind of feel it. Burberry's down by 10% today. The whole sector's down, but Burberry's down by 10%. I would have thought that everybody by now would have known that the consumer is going to come under pressure. And Burberry isn't that super high kind of price point like Hermes. It's kind of further down. And the further down you go, the more pressure you're going to feel from exactly what Megan Green was talking about.
Yeah, and just looking through all the analyst notes when it comes to Burberry, they're saying, look, it looks like about a 10% impact to the full year 2024 EBIT guidance, right? And you have to wonder, like, maybe we were hoping that this was the end of the luxury washout. But if we're higher for longer, or if we see more hikes, as Megan Green was just talking about, does that actually mean that things do get worse for that sort of high-end tier of luxury, except for, you know, Hermes?
Yeah, Hermes seems to be the only one that seems to be immune at the moment. Yeah, it's going to be interesting. They're basically signaling that they think if we continue to see this pressure, that their top line targets for the end of the year are going to be unachievable. Other European stock stories that we should be certainly focusing on. I'm not sure you can go from luxury to chocolate, or maybe you can, but Hotel Chocolat surging as America's chocolate maker Mars agreeing to buy the British boutique brand. 534, I think it's paying 170% premium, I think is basically the story, which is why the stock has absolutely surged today, up by 166%. A good news story. Maybe not for chocolatiers. Anyway, closes next. So we're wrapping up the day here in Europe this Thursday. Let's look at what we've got. Germany outperforming, London underperforming. Basically what you've got are energy stocks are moving lower. Why are energy stocks moving lower? Because crude oil is moving sharply to the downside. That's being reflected in the big names. Many of those reside in London. London is under pressure. The DAX is having a better day. Siemens painting a much more positive picture. The German engineering giant really putting a positive spin on its numbers today, talking very strongly about China. The market liked what it heard. Siemens goes up, the DAX goes up. Generally, though, throughout the day, we've been on a downward trajectory. But we've had 3 really positive days. And actually, if you take a look at today, it's more of a gentle glide lower rather than anything kind of more serious. So what you're looking at here is a kind of a move sideways, I think, realistically, after 3 big days up. We're down by 0.7%, a little drift lower. Let's talk about some single stocks. HelloFresh, 3 weeks ago, confirms its guidance. This is the food packs. I'm trying to think of the right words. You basically take them, you make the stuff at home. There's a kind of other sides of the business as well. It's mainly Asia-focused. It has now changed its guidance. And there's talk about spin-offs in Southeast Asia as well. The stock is down really sharply on the back of that changed guidance. Look at how you get punished. Look at how you get punished by just a kind of a shift in the narrative and how big the market reaction can be. EQS looks like Thoma Bravo is interested in buying this communications business, this technology business. That stock really surging. Look at the spreads you're getting between the different businesses here and how they're being treated by the market. That's Siemens Energy. That's not the one I was looking for. Siemens Energy is down today, but Siemens is tracking sharply to the upside today. Siemens Energy hasn't had a good few days. Let's talk a little bit about what's happening with the day ahead. It is Friday. This is great news. What have we got coming up? We've got the European Banking Conference. We heard from Congress. We heard from Christine Lagarde today. We're going to hear from her tomorrow. Today we didn't get very much. Maybe we'll get a little bit more tomorrow. UK retail sales is going to be out as well first thing tomorrow morning. Keep an eye on what is happening there. The consumer is under pressure. Listen to Megan Green. Maybe there's more pressure that needs to come through. You've got the Moody review of Italy. Now, we've had an ongoing story surrounding the rating agencies and Italy. This looks like something's going to maybe crack soon. Watch Italy tomorrow and how it trades into that review. And finally, we've got this AI conference. Basically, you saw AI coming up at the Xi Biden summit yesterday. We've got a series of AI conferences, Alex, taking place around Europe. There's one, I think Madrid was today. Tomorrow is maybe Paris. The real narrative we're trying to get to here is whether or not we're going to see an AI Act anytime soon from Europe. Europe was trying to position itself. The EU was trying to position itself as kind of being out in front in terms of the regulatory narrative. The French and the Germans have kind of thrown some sand in the gears of that story. Are we going to get an AI Act? Where is Europe going to be? Is it going to be a regulator? Is it going to be an innovator? Is it going to be neither? I think that's what everybody's grappling with right now.
Yep, and we have the perfect person to ask on the eve of the AI conference being held in Paris, and that's Eva Meidel. She's a European Parliament's lead on the AI Act. So let's get right to it. Eva, I know you wanted an AI Act and to be a forefront here. Do you think we're going to get something? What are the sticking points that are making this an issue for Europe?
Well, you very well know that Europe was the first to put pen to paper. So we started our legislative efforts already 2 years ago, much before ChatGPT came in the picture. We are currently at the final stages of our negotiations. So probably by the end of the year, I cannot tell with certainty, we'll be concluding our negotiations, but we are getting there.
Eva, the issue right now, as we understand it, comes from France and Germany, who don't want the foundational models, i.e. ChatGPT, to be included in the legislation in the way that was originally conceived. What is the compromise here that is going to allow regulation but allow room for maneuver so that Europe can develop its own models as well?
Well, this has always been at the core of my work. I have always stood behind the principle that we need to work on regulation that also enables innovation. And this is why I'm glad that EU AI Act is taking its time to make sure we are hearing all positions and to make sure that we will not stifle innovation. So I very much look forward to the discussions that will take place next week, where hopefully we will find a position that will be favorable for the member states, for the European Parliament, and the European Commission.
I mean, I'm obviously talking my U.S. book because I feel like the U.S. goes the other way. We just do all the stuff and then regulate after the fact. And sure, things happen. Just take a look at what's been happening with crypto, say SBF, et cetera, SBV, for example. What's your level of confidence that you can do both? Like, how do you regulate and innovate at the same time? Those two very much seem counterintuitive.
Well, I have to say that we are notorious for our Achilles heel in a way, because we lack innovation compared to the US and China, for example. We are strong in research, yet we lack in deployment and scaling up. So the AI Act can partially support certain processes, but we also need to make sure that we have true competition in the single market, that we develop capital markets union, that we do invest in innovation, that we attract investment. So AI Act is part of how Europe can be competitive, but it's not representing the full picture. So we need to think of other instruments at the same time.
Eva, if the AI Act does not move forward in the way that you would like, if we don't get it by the end of the year, will Europe be left behind? If Europe's not in front, where is it in terms of setting the agenda in AI? Is it going to be in China? Is it going to be in the United States? Is it going to be in the UK?
From my perspective, I had always said that I will not compromise quality over speed. Quality is the most important thing when we work on an innovative technology, which is developing way faster than we can legislate or that we can be prepared and understand it even. It's developing faster than those that are developing think it should be developed. And so this is why, for me, it's not about when we conclude, it's about what sort of legislation we are going to be having. Therefore, I prefer, and I'm glad we're taking the time to discuss, rather to strike a political deal when we are not clear of the details. This is a different type of legislation. And I think for the first time, legislators around the world have to understand that this time around, we cannot strike the traditional political deals. We cannot be doing business as usual type of legislation because we need to have a different understanding of a technology that is evolving faster than we've expected, and we've never legislated before. Usually, previous type of legislations were based on another legislative file that has happened some years ago. And this legislation, we also need to understand that it's complementary to legislations that we've adopted in the past, such as the GDPR, that I know many of you are familiar. And it will be complementary to legislations that are coming in the next months and years to come. So it cannot be seen as a silo legislation. But to also answer your other question, I think Europe should not just think of itself as setting the rules, but it also should think of itself as being part of the game. And those two things, as I mentioned earlier, they go hand in hand. We see different regulatory efforts happening from different parts of the world. But the most important thing is that in a way they're complementary. We are all thinking that some guardrails and rules are necessary. What's important is that it's the democratic countries setting those rules together. So the US, the UK, the EU, and others, part of the G7, should be talking to each other and setting the guardrails of how to govern AI.
Eva, thank you very much indeed. We will watch with a great deal of interest. Eva Maydell, member of the European Parliament, spearheading this move towards the AI Act. European stocks have now finished for the day. The FTSE 100 finishes near session lows. Not much action during the auction. Oil, the big factor there. Siemens, the big story in Germany. Coming up, Macy's topping Wall Street estimates on improved inventory management. We're going to have highlights from our conversation with CEO Jeff Gennette. That's next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Stephen Senter, Kia Motors America Executive VP and COO, joining Bloomberg Television at 1:15 New York time. This is Bloomberg.
Stocks rolling over a bit, volume still staying firm. You're staying a bit in the Treasury market. Abigail is tracking all of these moves for us. Abigail?
Yeah, definitely a little bit of softness here right across the board, Alex. Take a look at the S&P 500 down 0.3%. You can see the NASDAQ 100 down more, being weighed on by big tech, down 0.4%. A little bit of a reversal to some degree of what we were seeing earlier. The Russell 2000, after the big rally on Tuesday, up 5.5%, the best day of the year, giving much of it back, down 1.7%. And then the Golden Dragon Index down 3.7%. Its worst day since early September. For the Russell 2000, that's the worst day of the month. I think that it's the sentiment around these two indexes that it's starting to weigh on the other two indexes. In fact, let's take a look at the technicals for the Russell 2000, because I was searching for what could cause the markets to roll over. Of course, you have to respect price, but you always want to take a look. This was the chart we showed yesterday. Look at how the sellers literally pushed the buyers down right at this resistance level, the 200-day moving average. This area, these three candles tend to be bearish. It does suggest that that gap there, again, that emotional buying, what I called yesterday, for better or worse, dash for trash, that it may in fact reverse and that we're going to see a move down. Some investors might be tricked by the possibility that it looks like a bullish consolidation pattern. I'm not so sure that that's the case. Let's wait and see. But right now, the sellers very much in charge of small cap. One other possibility, Guy, I always like to look for the moles. Take a look here at the dollar yen, down about 0.6%. That means the haven yen is higher. So some investors are seeking safety. And of course, when the yen rallies, that could mess up the carry trade a little bit, this could be another piece of why we're rolling over a little bit for stocks.
All right, Abigail, thanks a lot. Really appreciate it. So staying in stocks for a second, because this is not one stock that isn't rolling over, and that's Macy's, still up by 7% off the highs, but nonetheless, beat third quarter profit expectations, better inventory management. That was their real sort of struggle point over the last year. So now we're joined by Bloomberg Technology co-host Caroline Hyde, who just got off the phone with CEO Jeff Gennette. So what was your take from the call? What were some of your big takeaways from your call with Gennette?
And it's his last earnings call. He's handing over the reins. So Tony Spring, actually the incoming CEO, was there on the call as well. The takeaway is they're managing a decline. They have to remind everyone this is a cyclical business. The consumer is at the moment in a more vulnerable position. We know that they're facing student loan payments. We know that we've got higher interest rates. So how can they have the right offering at the right time at the right place? How can they have your ski outfit when you're going to go and do it? How can they have your wedding outfit? How can they make sure, therefore, that they've got the right price point on the beauty that everyone's still spending on? Bluemercury saw growth in like-for-like sales, but that's the only bit of the business that is. Everywhere else, they are managing this decline. You're seeing sales roll over, like-for-like sales down some 7%, but it was better than the market anticipated. They're managing to manage that inventory at all costs, and this is a theme that we saw with Target as well, but really you are seeing from the likes of Jeff Gennette saying the consumer is under pressure at the moment. We've got to be more choosy. How are they going to be spending in the right times of their budget? So that was one of the key sort of anecdotes that I got from Jeff Gennette, that they're really managing to be at the right place at the right time, but ultimately this is a consumer under pressure guy.
But if the consumer continues to be under pressure, this inventory management, which they've already done now, doesn't protect them, I'm assuming, for that long. The top line at some point is going to drop through to the bottom line and won't have that protection in the middle anymore.
And I think that's exactly what Neil Saunders, for example, the key retail analyst, was saying, that is this just managed decline? Are we ever going to see any top-line growth again? We put that to Tony Spring. Interestingly, he was saying, look, they are optimistic about the things they control. The fact that they are investing in their own line of brand, particularly aimed at women. The fact they are investing in digital. We can bring you that quote coming from Tony Spring at the moment, that, well, the controllables, this is a cyclical business. It will come back again, and then they will have the right offering. Remember, this is very much an omni-channel kind of a presence as well. This is why they're really focusing on digital, trying to be more personalized. So as you can see, Tony Spring there saying, we are managing a decline, but we have several consecutive declines of sales overall, and the erosion is there, but their optimism is grounded on the things that they control. And they're going to work with merchants, with digital, with store teams. And remember, they are putting more sort of smaller stores, smaller Bloomingdale's, smaller Macy's. They're getting out of perhaps the malls to be where a person wants to be shopping right now. Their competitors are everywhere, whether it's Amazon, whether it's Instagram, or whether it's indeed the more boutique stores.
Yep. Alex really only cares about the sales.
Totally.
And if they're managing
100%.
inventory better, maybe there won't be any.
Yeah,
Caroline,
not good for me.
Yeah, not for me. Alex, we'll take that very seriously, though. Caroline's going to be back very shortly. Bloomberg Technology is coming up. Thank you, Caroline. Let's turn our attention now to what is happening with the APEC summits, the Asia-Pacific Economic Cooperation Summit, which is still ongoing in San Francisco. Rahm Emanuel, U.S. Ambassador to Japan, is now joined by Bloomberg's Anne-Marie Hordern. Anne-Marie, over to you.
Thanks so much, Guy. That's right. I'm joined by Rahm Emanuel. He's the U.S. ambassador to Japan. We last spoke at the G7 in Hiroshima. You were also...
It was so memorable.
It was memorable. You got a lot done on that trip when it comes to countering China. And that's where I want to start, because this was warming of ties. The relationship almost couldn't get any worse than where it was. But you've been quite critical of China. In one of your tweets, you talked about the rumors of the disappearance of top officials, and you said, who's going to win this unemployment race, China's youth or Xi's cabinet? Given that criticism, and the White House was trying to pave a way for this visit, did they tell you to tone down some of your social media posts?
Do I look like I'm toned down? I mean, I've been very clear about Fukushima, that China continues to fish in Japan's water, even though they're banning that fish in clear violation of trade agreements. I mean, to me, the big point here, and I think that the most important point is, nobody's under any illusion. I thought what was very interesting in the meeting is after the meeting, President Xi decided to have a dinner with a bunch of American CEOs who gave him a standing ovation. I was with President Biden last night, where he had a reception, and there were world leaders from the entire region. A number of country heads of states. Prime Minister Kishida was there, as was President Marcos of the Philippines was there. And I think that is a telling sign, the split screen. President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing. The coin of the realm for the United States, we have allies, we have friends, and they want to be aligned with us. The fact that there were foreign leaders with the president here at the APEC conference and American business CEOs who literally have their R&D, their intellectual property, stolen from them, has decided to give President Xi a standing ovation. And I think that is a telling sign, that split screen, because I tell you who's got strength and who's got vulnerabilities.
Well, this is another criticism you've pointed to China on your social media posts. You're very prolific on Twitter. You said
I can only type so many words.
You said you said lying and cheating is the modus operandi when it comes to doing business in China. Was it wrong for these executives to show up last night, and some of them paying as Mike Gallagher of the Republican chair of the China Select Committee says $40,000 to sit at Xi Jinping's table?
Let me just say, well, that may be a telling sign of how desperate China is for investments. Let me say this on that point. One, I cannot tell you as chief of staff how many times the CEO came in to my office and said, I have to give away all my research and development. There's intellectual property theft. There's basically IP theft going on, and there's spying going on. And then you say, okay, let's file a WTO, World Trade Organization complaint. They say, oh, I don't want to do that. So to me, we as taxpayers fund that research and development. We have a say in that research and development. The fact that you're giving away America's future, and you just have to give it away, that's not in our interest. It wasn't wrong for them to show up, but you should have no rose-colored glasses. Number two, over the last 30 years, definitely in the last 20 years, too much of America's national security or relationship with China was dominated by commercial interests and not by our national security. Has to be brought into balance. And number three,
has the West learned its lesson from Russia?
Well, I think under President Biden, absolutely. Clear-eyed about it. And number three, let me take one other point. As ambassador for the United States to Japan. There are three major companies in the world that produce machines that are essential for semiconductors. Canon, Tokyo Electron, ASML in Holland. 3 months ago, it was identified that there was a spy stealing trade secrets and economic secrets, patent secrets from ASML. Not Canon, not Tokyo Electron, not another country except for China. Now, we can't allow an economic system based on trust and a rule of law to operate where one country is stealing intellectual property constantly. That is happening across the
So should this administration be doing more?
No, they are doing more. You and I aren't having this in the past. All those problems, this is a mistake, bipartisan mistake. Those problems got swept under the rug. You're going to have the dialogue the president established yesterday. We're going to be honest with each other. We're going to tell each other where there are lines. In the past, those type of things by CEOs in America got swept under the rug because of the lure of the size of the market of China. That will not happen anymore. The enforcement of the rules of law will happen, and it's going to be clear. There will be commercial trade, but it will not be one where you get to steal and we all get to, or get to subsidize and destroy a market of the United States or a market of Japan or a market of the EU, and we actually turn the other cheek. If you're going to be part of the international system, you're going to abide by the international system. And the president has been clear, which is why, again, I go back to this, we have allies and friends, because everybody knows between rules or raw exercise of power, rules have a seductive lure because that is fair. And people do not want to live in a system where intellectual property theft, subsidizing of industries get to destroy other countries' economic independence and sovereignty.
What do you make of the president, though, ending his press conference on the way out, gets this shouted question? He says Xi Jinping is a dictator.
Yeah, well, he's stuck by what his view is. I think the evidence is pretty clear based on what's going on in China. And I think that that doesn't mean you don't have a conversation, as he did. And I do think one other thing that I think is really, really important. When you look at Russia's war in and on Ukraine, you look at Hamas's terrorism and the conflict in the Middle East, yesterday was a day for diplomacy and dialogue. Now, in all the conflicts around, it's better to have conversations. And why? Because you and I don't know, nobody knows, where does deterrence end and provocation begin? So it's better to have a meeting of the minds, better to have a dialogue, better to have established lines of communication. You'll have differences. Doesn't mean you're not going to have differences, but you know who to talk to each other, you know whether you can trust the other person's word. That has always been the case. So in the context of right now, better that that happened, better that we have a way of knowing who's on the other line, and better that they know each other and have some history so they can, when conflicts do emerge, they don't go forward.
They
don't spiral out of control, rather.
Right. President Biden, though, is obviously going to be focused the next year, really putting foreign policy to the backseat because he has to focus on a re-election campaign. And I want to read to you a little bit of what Jonathan Martin, Politico's senior political correspondent, said. He said, the best service you can do, Mr. Rahm Emanuel, is come back to the United States and chair Biden's re-election campaign. He actually said that George H.W. Bush waited too long to bring James Baker back to do this. Is that in your future? Do you plan on potentially leaving Tokyo and coming help Biden get reelected?
Look, I was honored by President Biden to serve as U.S. ambassador. I want to see my mission through. I'm very happy. Thanks for Jonathan Martin to literally have to answer this question. That said, I enjoy this job. I've enjoyed all the jobs. I serve at the behest of the President of the United States, but I am very much committed intellectually, politically, emotionally. I really enjoy the work that we're doing, and we're making history, as you saw in Camp David when Japan and ROK got together. As you saw, Japan's now going to go from the 9th largest defense budget to the 3rd largest. They're getting capabilities like Tomahawks and counter-strike capabilities. So to me, this is very important work, and I serve at the behest of the president, and I'm going to continue to serve at that.
So you're staying put, and no one has told you to tone down your tweets?
You take a look at it every time I continue. Nobody's told me to tone down. It wouldn't be successful to tell me to tone down. And the continuation, like I'll deal. We're dealing real live now. Classic example of what I think is a real problem. China has banned all the fish from Japan, which they have a lot of fish that comes from Japan that goes to China. Yet, having banned it, China continues to fish in Japan's EEZ and use that same fish. So that hypocrisy does not have a place in the international economic system. You could either be responsible or you can use raw power, but we're going to enforce the rule of law.
Rahm Emanuel, thank you so much for your time. Alex, that one, of course, was the U.S. Ambassador to Japan, Rahm Emanuel, also former mayor of Chicago and chief of staff to President Obama.
Yep, and really sticking to that ambassador to Japan there. All right, thanks a lot, Emery. Really appreciate it. Great stuff joining us. And just a quick check-in on the markets here. You look at the S&P off by 10 points at by 0.2%. So nothing to see there. And the bond market still seeing a solid bid, really the belly outperforming. All right, coming up, Matt Murphy, Menio Ventures partner, joins Bloomberg Tech with Caroline Hyde and Ed Ludlow. This is Bloomberg.